So let's hop right into it. And Steve, if you don't mind, I'll ask you the first question. And as always, we'll allow everyone to hop in and provide their own thoughts after Steve responds. But Steve, as you see it, what are some common mistakes entrepreneurs make when first forming their business?
Thanks, Jack. I think one of the things that people do is they don't take the time to really think about what it is they want to do and how they want to get there. They have this great idea and they spend a lot of time running around trying to put it into practice, but don't make a lot of headway because they get distracted. Now, not to say you don't have an idea and you take it down the path and you have to shift direction or whatever. But that is one of the things. The other thing I see too is not keeping track of what they have. And one of the things there, especially in the technology world, is intellectual property and keeping an eye on what is your intellectual property, cataloging that, and then being able to monetize that. For example, there's copyrights. If you create something, whether it's code or a story or whatever, there's trademarks. For example, Jeff with Carta, the Carta branded cap table management service. That's a trademark. That's valuable. Everybody knows about patents. That's a much more complicated process, but those are also very valuable as well when you're trying to generate your world. And one thing too with patents, I've seen people do is they expose their idea to the world without protecting the secrecy of it, which if you're not careful can ruins your ability to get a patent on that. So that's one of the big things I see with patents.
I love that. And from your worldview, Kyle, how what are some things you see that may be considered mistakes or missteps when forming a business?
Yeah, real early on, right? I mean, obviously cash is king, right? Nobody wants to pay up for the right services, whether that's legal, accounting, finance. But in the long run, we've seen it be able to save you a lot of money because it was set up right out of the gate versus, going with your neighbor who happens to be a single shingle attorney or CPA provider. And then not only do these professional providers, when you go to raise equity, they have to redo all the previous work coupled with get you ready for where you're going to go. That's kind of one of the most common. And then kind of the other one that we see is kind of a chicken and the egg, right? I mean, Jack, as you know, some companies will say, well, if I could only raise this capital, we'll be able to go do X, Y, and Z versus saying, figure out a way to go do X, Y, Z, and then that capital will be available for you. So, those are kind of the two things that really jump out in my mind.
Kyle, I'll add to that. Just to give Steve a good plug here, probably the best thing that you can do as a founder starting out is to get a good startup attorney. Like Kyle was just saying, that's going to pay for itself. Do things right from the beginning and do it early on, whether it's, figuring out what type of entity even you're going to be. Your attorney can help you walk through that process and say, well, what are your plans? Are you going to be raising capital? Should we start out as an LLC or should we just create this as a C Corp if you're going to be raising capital from institutional investors pretty quick? So all kinds of things like that. If you do it right from the beginning, it's going to end up saving you time and money in the long run. And then the other thing that I see out there is just keeping track of everything, kind of like what Steve was saying. One thing you do see you'll see early stage founders do is they'll go out to raise money and they don't realize how important it is to keep track of what they're raising. And that just becomes critical, especially as you get into further, future rounds and things like that. So a couple of things to kind of keep in mind there.
We've touched on some really interesting subjects here, and I'd love to continue on each of them, starting with, Jeff, you mentioned corporate structures and maybe figuring out what's optimal for your business plan. And so, as the group here, maybe Jeff, you can start us off, but as the group has some opinions, what are some of the best practices you see or you would you would encourage when optimizing corporate structure for future fundraising, taxes, ownership management, et cetera, et cetera?
Yeah, great question. And again, Steve's probably the best person to talk to this, but what you do see is that if a company is going to be raising capital from an institutional investor, that institutional investor is going to most likely require the company to be a C Corp and probably incorporated in Delaware. And so, to do that right out of the gate, if that's the path you're going down, might make sense. There may be other instances where, let's say you're going to, be cash flowing pretty quickly as a company, and there's not a need to raise a ton of money down the road. Maybe it makes more sense to be an LLC, but that's again where your attorney and advisors are going to, definitely pay for themselves just with the advice that they'll give you down that path.
Yeah, Jeff, thank you. I agree with you. And to follow on with that's very common. What I would tell people is, if you think you're going to be raising money quickly, let's go with a corporation structure, entity structure. But if you think you're going to just be operating a business, I tend to steer people towards an LLC because it's a little bit less annual paperwork type stuff you have to keep track of to maintain the entity. And a lot of it too, there's a conversation with the person's accountant and what's the best tax structure for that particular company and the members or people behind it. So always involve the accountant too, at least in that initial phase.
Is it, for the untrained mind, is it a big issue down the road if you start as one and need to switch for another? What's that process like? No, I mean, you can convert from an LLC to a corporation, or you can change the way you're taxed. That's a little bit simpler. The tricky thing, and actually I have some clients going through this right now, is making sure, as I think Jeff alluded to, making sure you have a good handle on what your equity positions look like. Because you can always convert from, say, an LLC membership interest to stock. But if you don't know how much relative equity somebody has, that's a really difficult thing to figure out, and probably requires some really interesting conversations with your owners about how is this going to happen, and probably could be expensive if you don't have good relationships.
Yeah, just to add on to that, you do see it happen where a company will form as an LLC, and they'll have a really weird structure. They'll have, things that don't translate necessarily into, stock shares or, things like that. And so, make sure you if you do foresee that you might be converting to a C Corp down the road, you can set up your LLC so that it is able to convert a lot easier if you set it up properly from the beginning.
Yeah, I mean, again, right, talk to your attorney, talk to your CPA. I mean, other things to think about too is, how are you going to be hiring? Are you going to be granting stock options to new employees as an incentive to bring them on board? Because maybe you're offering below market salary. It's a lot easier to give them shares from an option pool of a C Corp than it is ownership units in an LLC or create a phantom equity pool.
Yep. That's a really good point. And actually people not get into trouble, but issuing equity in an LLC creates a bunch of tax issues for the employees, because they frankly, from an IRS perspective, are no longer employees. They're partners if the LLC is taxed as a partnership. So
we're touching on a subject that I would assume a lot of founders don't really spend time thinking through off the bat. They should, but you're thinking about your idea and getting to market and just bringing on the right people. But obviously, ownership structures get convoluted very quickly. And as a group, I think we're touching on why it's so important to have a good understanding of them. But maybe let's dig one level deeper, both, what are some of the implications of not getting this right off the bat? But then two, how do each of your respective firms help people manage this?
I think I think Jeff touched on it is not keeping track of it. I think that's the thing where people go the most wrong. And also maybe not keeping track of, let's say the friends and family round comes in at, I don't know, just for round numbers, $1 a share. But then 6 months later, you go out and raise money at what ends up being $5 a share. How do you manage those equities? I think people get into trouble there when they get focused on getting the money in and don't think about how it's going to impact the rest of their cap table. Which frankly, I think is people they get focused on, I need money, and they don't think about, hey, yeah, this person's willing to write me a check today, but is that a check I really want to cash? Because I don't know, it's going to mess up my cap table, or it's someone who wants to do a whole bunch of different things that I'm not interested in doing, and there's a lot of strings attached to this money. So I think that's something that people get themselves not in trouble with, but I think that it creates some issues, and it's fixable, but it can be challenging to unwind down the road.
Yeah, I mean, from SVB's perspective, we can work with anyone from an LLC to a C Corp to an S Corp. And obviously, we're not attorneys like Steve is, so we won't advise on that, right? The company, the founders, the investment professionals are going to determine what the right structure is. And typically, it's going to be a Delaware C Corp if you're going to go raise multiple rounds of financing, or if you're going through a buyout private equity type structure, typically it's going to be an LLC so that the taxes get passed through. Other than that, those are kind of the two typical structures, but you always, need to do your due diligence and rely on the team that you've brought together to support yourself in the business.
The thing about keeping track of who owns what in the company is so critical, especially as you get into, raising capital. One of the first things your investors are going to ask you is to see your cap table. And, if they are seeing errors in your cap table, or that you haven't done things correctly from the beginning, you haven't kept track of things, that's a big red flag in a number of different ways. First of all, it's a reflection on how you're managing the company as a founder. And so, if you're not keeping track of your equity now, and they're going to be investing in the company, and that puts a risk right up front on, what are you going to do to keep tabs of my equity? So I can't tell you how many times we've seen early investors left off of cap tables, or, mistakes in terms of equity percentages or the, shares being granted. It's super critical to keep track of it. And it's easy to keep track of from the beginning if you just, make an effort to keep track of it. And one last thing is to make sure as you're keeping track of it, to also inform your attorney and make sure they're in the loop as you're keeping track of things as well.
Right. And that, Jeff, I agree with you. And because that, if we have all the information, it's a lot easier for us to advise. And there's been multiple times where I've given somebody advice and they say, oh, by the way, I forgot about this, which changes the advice 180 degrees. The other thing too, and I know this is a panel focused on equity and capital and fundraising, but I do think one thing that I wanted to mention is sometimes I think people get too focused on raising money and selling equity and doing that kind of stuff, and they forget to focus on the idea and the business. And I've seen companies fail because they lost focus on, hey, I had this great idea and I started a company and I'm going to go build it up, and then I got sidetracked with trying to raise money, which I get, but I think that people need to remember to focus on that business idea that got them to this point, and not get sidetracked in just the fundraising stuff.
Yeah, raising capital can be a full-time job, and then you still have your day job of being a CEO and probably, maybe a CTO, and you're going to be the head janitor, and you're going to be doing everything else too. So you got to make sure that you continue to execute so that as you're talking to these investors, they're seeing the progression and you hitting the milestones and delivering upon what you say you're going to.
Mm-hmm.
I might back up even a little bit further and even talk about, finding product market fit. So many businesses fail because they they don't find the product market fit, and they may even go try and raise money or spend their own money and their own time before they find out that they don't really have that product market fit. So that's probably your first step, is to make sure that you are validating your idea and, saying that you've got something worth investing your own time and money in, first of all.
Mm-hmm.
We're talking about an interesting stage of company, both at formation and shortly thereafter. And we're also touching on financing rounds, which I think is a fascinating topic to bring up with the three of you. Focusing in on these angel and seed rounds, or the friends and family angel and seed rounds. Clearly we're stressing how important it is to really put some thought into how you fundraise, but specifically around investment structures. What do you guys recommend to new founders? I mean, there are a bunch of creative ways to raise money, but convertible notes, safes, priced rounds. What do you guys see as the benefits and hangups of each, and how do you mentor and advise people along that journey?
Yeah, I mean, ultimately, the company's going to decide what the right structure is for them. Typically, real early on, 90% of what we see are either going to be converts or safes. Now the downside of those are, if you raise convert upon convert upon convert, all of a sudden you have this huge stack of capital there that's going to convert at a significant discount, and you can't forget about what that is going to mean long term when you go out to raise a Series A. How much does that dilute you out? Things along those lines. And then, in the last, probably 2 or 3 years, there's been a proliferation of safes as well, which is, from a legal standpoint, that's where I'd look to Steve to see, what the pros and cons of are both. However, from a founder standpoint, they're kind of one in the same, as it's a vehicle to get capital in, with keeping it as simple as possible without having to do priced rounds, ongoing 409A valuations, all of these sort of things, to make sure that these equity investors aren't getting hit with undue tax consequences.
I kind of have. I guess I'm talking out of both sides of my mouth about safes. If I'm representing the company, I think they're great because it's not free money, but it's a lot easier. The safe is a simple agreement for future equity, but if you I guess, depending on your perspective, set the conditions right when it converts, it may never convert, so it may just be effectively free money. From the investor standpoint, that's a terrible investment, because you may invest $100,000 and never get anything back for it. But I do think that they're an effective mechanism for people to easily go out and get money in the early stages and not have to deal with all of the complexities of a priced round and the SEC compliance and all those kinds of things. So from that perspective, it's great for the company. I think as a middle ground, I probably would lean a little bit more towards a convertible note, because my sense is that the investors are more willing to go that route if it's not a full equity round. I'd actually be curious to hear what Kyle and Jack and think about that from the bank and the VC side.
Yeah, I mean, safes are what they're designed for, right? They're fairly simple. I agree that a convert may be more appealing to the investor. Obviously, it creates a little bit more administrative burden for the company. You've got to accrue the interest. You've got to do all these other sort of things. So you have to make sure that you have a finance staff that can handle it. So it's really kind of, taking a look internally at the company and saying, what is our horsepower? What are our skill sets? What are the capabilities that we have? And what's going to be the right structure based upon guidance from our legal team and our CPA team? And I mean, I think Jeff probably has a ton of data on that, how many safes he's seeing versus kind of converts here recently.
Yeah, it's interesting. It can be somewhat regional. The safes are very common in Silicon Valley. Whereas in the Midwest, for example, it seems like convertible notes are much more the norm, and other areas of the country as well. So I think part of it is just kind of the, what people are used to and what they get comfortable with. But I think one of the keys there, regardless of whether it's a safe or the convertible note, one of the beauties of the safe is that it's standardized, so everybody kind of knows what they're getting, and on both sides. But I heard recently in one of Fred Wilson's blog posts, Fred Wilson from Union Square Ventures, he mentioned that as long as things are standardized, especially early on, then that's what the investors are looking for. They don't want something really weird and out of the norm. And so his suggestion was go get some standard docs from a reputable law firm, send them over to us as an investor. We'll look at them and we'll just agree to use their standard docs. And we can make this just as simple for a price round as it would be for a safe round. So, I mean, again, it depends on the investor you're working with, but I think the key is standardization at those early rounds and keeping things simple and standard.
Yeah, and I think for the priced rounds, I mean, Jack, as you can attest to, the investors are going to get the ownership interest that they need at the end of the day anyway. So it's a function of valuation and price per share. And obviously, if it gets too out of line, the investors walk away from the deal because they need to get X amount of ownership to make it work with kind of their first investment, right? I mean, it's not rocket science. So, typically 15 to 20% ownership, maybe up to 25 per round. And then you can just kind of figure out that sliding scale.
This is an awesome discussion. As the investor, you guys are nailing it from our perspective as well. Standardization means a ton. Don't overdo it on convertible notes. Kyle, you said that off the bat. You got to get priced in eventually. And we really, when we're coming in and pricing around, if you've got a ton of notes outstanding that are going to turn it from a $2 million round to a $4 million round as they convert, it gets wonky and it's clunky, and it's more for us to manage and think about. And so we always say, just make sure they're not too cute, right? Just standard, normal terms, standard terms, don't overdo it, and have the discipline to price when the time's right. We're running out of time over here. So what I want to do is just spend the last 3 minutes or so and give each of you the opportunity. We mentioned off the bat, it's important to get these things right. It's important to work with the right individuals early on. And I know each of your groups have really interesting ways of engaging with the youngest of companies, be it through discounts or price benefits or just really a really comprehensive package of services that can help people get started out right. So maybe if you don't mind, I'll start with Jeff, then Kyle, then Steve, kind of in the order on my screen. If you can just kind of give us a couple one-liners on what it means to work with you guys right off the bat.
Yeah, thanks, Jack. Appreciate it. One thing with Carta, not too long ago, we rolled out a free version of the Carta cap table management software. It's called Carta Launch, and it is free for companies that have raised up to $1 million and have 25 or fewer individuals on their cap table. So, that's probably an easy way for founders to get set up right out of the gate on a cap table management platform that helps them keep things in order and do things correctly right out of the gate. And typically you can go to your attorney and have them help you set it up, or, we've got a self-onboarding mechanism as well.
Yeah, and I mean, from SVB's perspective, we've tried to bring best-in-class, world-class services through the entire spectrum of the portfolio. So 2 people in a garage with an idea, all the way up to large multi-billion-dollar public companies. And real early on, the reason we're here for Startup Week is, we offer 20, if you're an SVB startup client, there's an Edge bundle package. You get a 25% discount on your first year subscription at Carta. You get 20% discount on Zoom, all for being an SVB client. We've really used our kind of horsepower to go out to these best-in-class solutions and say, hey, we are trying to help these companies grow and scale. And if they go to you, you're going to get more. But, if they're working with us and they've been vetted, in theory, it might be a longer standing client. And then all the way up to kind of the growth and public companies. We can, the value differentiator for SVB versus a more traditional bank is the ability to leverage institutional equity rounds. Because we're very familiar with most of the investors out there. So we can call partner ABC at Fund XYZ and say, what attracted you to this investment? What milestones are you tracking to get them to that next institutional round of equity? Oh, and by the way, we've all been doing this a really long time. What happens if they miss that milestone, or what happens if they completely exceed that milestone and need more cash sooner than they had originally forecasted? So it's just partnering with all the various service providers and really trying to help up-level everyone's game.
Yeah, similar for us at Hawley Troxell. We've been around this world quite a while. Been in the his firm history goes back to Idaho as a territory, but we're also we're in Idaho, but we offer Silicon Valley, New York, whatever. I think we offer Idaho service, which is better. But we have all those capacities here, legal capacities here in Idaho at Idaho rates. So we're not cheap, but we're also you're not paying Silicon Valley rates either. So we can do all the same things for that rate. And look, we get the startup, and we understand that cash is tight. So we're willing to find ways to creatively help people get their businesses off the ground and then take them to the next, hopefully like 12 or 15 levels up.
Guys, this is fantastic. Jeff, Steve, Kyle, our sincerest thanks for your participation in this panel and for your ongoing support of the Idaho startup ecosystem. It's a privilege to be here with you.